Hey everyone, it's Mike from Orderflows here, and welcome back to my channel. I'm glad you can join me for today's video. We're going to be talking about one of my, original and favorite trade setups I still look for today in the order flow footprint chart. Now, before I jump in, if you enjoy learning from my videos, don't forget to subscribe and click that notification bell so you don't miss any new uploads. It's been a while since I've uploaded some videos, but I'm finally feeling healthy again. I'm getting back into the groove. So you want to be notified when I do post new videos. So if you find today's video helpful, be sure to hit that like button for me and leave a comment sharing your biggest takeaway. I do love hearing your feedback. I do read them. Sometimes I do reply to them and make videos off them. So your support really does go a long way in helping me create more videos just like this. All right, so if you're getting value, be sure to tap the subscribe button and let's grow together. All right, so let's jump into today's topic. When I first started trading with order flow, on a footprint chart, that is, there were certain things that I looked for. And, as my trading sort of progressed as a retail trader, I used to work on the institutional side, right? I spent a lot of years at investment banks and trading firms. Then after I sort of semi-retired and then eventually fully retired, I would watch the market, but when I was watching the market on a normal bar chart, something was missing. And then when I found the footprint chart, I was like, oh, this is exactly what I needed. And there are certain things that I always look for on a plain footprint chart. And this is something you can do no matter what type of footprint chart you're looking at. As long as you got the volume trade on the bid, the volume trade on the offer, it's something that you'll see time and time again. And when I did sort of move into the software business, right, when we created the Orderflows Trader software, this was one of the original tools that we put in the software. And again, I got into the software business because I created the software for my own trading, right? And then other traders saw it and wanted copies. That's how I got into the software business. I didn't set out to create the software with the main purpose of selling it. It was really a tool to help my own trading. And it's what we used to call single prints. We changed the name years ago to Exhaustion prints, because what happens in the market when the market gets exhausted, right? Think about it like this, right? You're running. You say you got to run to catch a bus or something. And, you're running, you're trying to catch it, and you get tired, right? You got to slow down, right? And that's what happens in the market. Eventually you stop running because you got to catch your breath. And market's the same way, right? So moves going up, generally have a lot of strength early on in the market, but as they get up near the top and as moves tend to end, people can lose interest in buying it at higher prices, okay? And same thing with moves down, right? Moves down end when the last seller has sold. So think of it that way. Moves up end when the last buyer has bought, moves down end when the last seller has sold. But it doesn't necessarily have to come at ends of moves. It can happen sometimes in the middle of moves. And today there was a great example in the S&Ps. Okay, so this is just a plain 1 minute chart. People always ask me, what's the best chart for trading? Well, it's really the chart that helps you understand what you're looking at in the order flow. Okay, and around 925 to about 940, we're going sideways, right? We're trading basically between 47.5. I'll just draw a line here, and basically 50.5, right here. Okay, then the market broke and went down to new lows, right? It broke about 10 points within a matter of 5-6 minutes. And if you're watching the order flow is kind of normal going through here. But what was unique about this is right before it started breaking out, you saw a sign of traders no longer interested in trading around the 49.50 level. Okay, and people say, well, how can you see that? Well, what I look for when I'm looking at the order flow, right, is how it's trading around the edges of bars. Okay, so here, right, we have a red candle. What I'm interested, one of the areas that has my most interest is right up here at the top, right? Because why is that interesting to me? Well, the market reversed, right? It traded up and then it closed lower in a red candle. That's how red candles form, right? The market often will open up, generally will trade higher. Now, again, it could open on its high. then gets slammed and closes lower. That happens in every red candle. A green candle is the opposite, right? It opens, usually goes a little bit lower, then goes up, closes higher than where it opened. So on the red candle, what am I interested in? I'm interested in what's happening at the top of the bar, not necessarily at the bottom of the bar. Just as on a green candle, I'd be interested in what's happening at the bottom of the bar, right? Is there normal volume going through, or is there lack of volume going through? Has the last trader bought or sold? Okay, so in this area, I'm looking, as just normal order flow going through until you get to this bar at 940 and you see a 2 here. Now, why is this relevant? Well, you just traded there a minute ago, and you've been trading there for the last 15 minutes, more or less. And you can see traded 122 when it was bid, traded 203 when it was offered. And then it comes into this bar here, right at 940. Opens up at 49 and a quarter, trades up to 49 and 3/4, where we just traded 203 on the offer, but only 2 contracts traded there. And then the market closed down. So think about it. You're going sideways for 15 minutes. Then as you try to push higher, you don't get sort of normal order flow. You don't get, 100, 200. You get 2 contracts, 1, 2. That's it, a pair trade. Do you think traders are still interested in trying to get it to go above 49.50? They've been trying to. They'd get it above 49.50 once, twice, 3 times, 4 times, 5 times. Hits it here 6 times. Now on the 7th time, maybe the 7th time is the charm. It's not. Traders aren't interested anymore. It trades 2. Then it closes down. Then it breaks and it sells off 10 points. This is what we call an exhaustion print. Again, now in the old days when we first released the Orderflows Trader software, we used to call it a single print, meaning there was a single volume in the sense of a number between 1 and 9. 10 would be a double print. But we've since renamed it years ago, and we call it an exhaustion print. So it's just 2. Now, that's all well and good, but if you're watching a dome, right, this is why people get into these stupid semantic arguments. Oh, a footprint chart is not order flow. It is. It's orders that go in and trade. Okay? A dome is orders that go in and sit on the bid and the offer. They're not trading. Is it important that there's 184 down here at 57 and a quarter? Yeah, it is. Problem is, we're trading 2 points higher, right? So is this information relevant? Well, maybe as we get closer down to 57 and a quarter, it is. But who knows? Maybe that gets pulled. We don't know, right? That's the problem when you're looking at depth of market. The orders go in, orders go out. There are always people adding and removing orders from the market. Whereas what trades on a footprint chart is the actual volume. And that's significant because people are committed to a position, right? Whether they're long or short, they have interest in a price level. So this is telling me there's only 2 people interested in buying up here. And if there's just only, or it could be 1 person bought 2 contracts, but whoever traded here, the interest was only 2 contracts. Okay, and other traders will say, no, you got to look at the depth of market, the heat map or book map. Because you see down here at 49.45, there's 453 on the bid. Yeah, that's nice information to know. Problem is we're trading 49.60. How can I use this information based off of where we're trading? Did we even, last time we were at 49.45 was, at 10 o'clock. This information was useful here, noticing that there's a big bid coming in. Okay, fine. You had a big bid here that got pulled later. So I'm not saying that, a book map or a heat map is useless. There are very practical uses for it, but the way that I've always traded with order flow, and this goes back to when I left the trading floor in the early 90s to go trading upstairs on the Globex. They used to call it the Globex desk because that's where all the machines were. We had CME had Globex, Board of Trade had Project A, NYMEX and COMEX had the system called Access. And, I'd be staring at the price ladder all night long, from 10:30 at night until 8:15 in the morning when S&Ps closed. And there were no minis where it traded around the clock. It was still just S&Ps. Then the pit would open at 8:30. So anyway, I digressed there a little bit. But, that's why I get more value, and I think a lot of traders get a lot of value from a footprint as opposed to looking at a dome. Now, the problem is if you're looking at multiple markets, right? If you're staring at one market, it's easy to see that. But nowadays, we all got multiple screens. Even my laptop, I could hook up multiple screens to a laptop, and all these desktops, right? We all got big monitors, and we're watching multiple markets at once. So you want to be able to identify these areas of market exhaustion, price exhaustion, if you will. Areas where traders are no longer interested and how do we know they're no longer interested? By looking at the volume, the lack of volume thereof. Okay. So again, this was one of the original tools when I released the Orderflows Trader 10 years ago. Now we've got about 15 and we're working on adding, another big group to the next upgrade. But here, exhaustion prints. Okay. So to see it on a chart, now there's two ways. We'll start with fixed and until tested. And you can adjust the level that you want. I like looking at 3. So it tells me, 3 contracts. Some people I know like to just look for markets where they trade just one contract. Okay. And some people like to look at 9 or 10. And you could adjust that here. So we'll keep it at 3. Hit apply. Okay. Now it's fixed. Okay. So if it's bullish, it's going to be green color. If it's bearish, it's going to be red color. Okay. And why? Because when you think something's bearish, you think red, right? When something's bullish, you think green. Green means buy. Or some people like to use blue. So you can see it right here. Okay. 2. And it's highlighted. Okay. And that's important for when you're looking at multiple markets. You want to see things right away. That's why we highlight it. And we also put this little down triangle. If it was bullish, it would be a green up triangle below the bar. But again, some people think, well, that's kind of hard to see. That's why we have the option to draw it out until tested. And what until tested means, it's going to draw out that zone until price comes back and tests it. Okay? Because oftentimes when you see exhaustion prints in the market can run quickly from them. Now, not all the time. Sometimes, market can go sideways, right? Sometimes you have bullish order flow, but no continuation, and the market goes sideways. But when you got bearish order flow or bullish order flow, and you do have continuation, you do have continued bearish order flow coming after a bearish exhaustion print like you have here, right? You got this nice stacked selling imbalance. Got actually 6 selling imbalances in the next bar. You know that this market's probably going to drop further. But you can see 2 here, right? This green line is actually an exhaustion print from way earlier, from the previous day, because this is the low for the day. But you can see it in here on this move down. Exhaustion print, exhaustion print, exhaustion print, all as the market is dropping. Okay, a little bullish one here. This was at 8:30, just after the cash opened. And, it's something that's stupidly simple to see. You don't need to be a math PhD to understand this. It's just telling you traders aren't interested at this price anymore. And if you know that, that's information that you can take and go trade with. And what I love about order flow, right? It's very robust. And what works in one market should work in another market, right? I get frustrated when I see people saying, I got an E-mini system or I got a NASDAQ system, and it only works in that one market, right? Really, it should be transferable to other markets to be legitimate and long-lasting. So, take a look at bonds real quick here. Okay, so bonds, right? Bonds is a bit different than S&Ps. It's a little bit slower. You don't, if you're on a time-based chart, you don't get a lot of price movement sometimes in 1 minute. Sometimes you're just going to trade the bid and the offer, or it can trade just one price. And so honestly, looking at a 1 minute chart is a little bit difficult. You just don't have that information that you'd like to see. Me personally, I like to use a range-based chart on interest rates. And you can see here, right? Exhaustion print 2, 3, right? Bearish, bearish. This is when we had some volatility in the market. You can see market just moving very fast. This is 9 minutes. You got how many bars formed in the first 10 seconds. You can see on this move down, exhaustion print, exhaustion print, exhaustion print 1. As the market's going up until 9 o'clock this morning. This is 9 o'clock. So again, you could adjust it whatever level you want. You know, if you want to use 1 or 2 or 3 or even 10, depending on the market that you're trading. Okay, I mean, I could set this to 9. As you know, bonds. You know, here's 2, 8, 1, 6, 6. Okay, you see a 6 down here right now. Not right now, but about 20 minutes ago. Okay, so again, it's something that is very useful for traders to look at, right? You don't need to go blind watching a dome trade, you know, because to be honest, you know, if you're watching a dome, in most markets, it's pretty stable. I mean, if I was looking at bonds, you know, 1,983 on the bid, 1,000 below it, 280, 800, 1,000. Okay, but if you really what you're looking at is what the volume is that's going through. You don't need to understand all this volume that's going through. All you got to do is just watch how it's accumulating on the chart, right? Where it's printing on the bid, on the offer. Is the bar up or down? Okay, what's it doing on the bottom of a bar or at the top of a bar, right? Watch the edges of the bars. All right, guys, so I'm going to end that video there. So thanks for watching my video on one of my favorite trade setups, which is exhaustion prints. I hope you find this tip helpful for your understanding of order flow. And let me know what you'd like to discuss next by leaving a comment in the comment section below. So if you haven't already, be sure to hit that like button and subscribe to my channel so you don't miss any more of these videos. So thanks so much for watching and being a part of my community. Your support is appreciated. So I'll see you guys on the next video. Okay? Bye-bye.